Well, holy smokes, everyone. We have some new massive news. What's going on in the markets, what's going on with retailers, what's going on with the economy, but most importantly, what the central banks are doing with gold. So everyone, this is going to be a very, very important update. I have a lot of news and articles to show. It's going to be an action-packed condensed episode and also a very important announcement towards the end. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. Chicago PMI crashes to 40, the 9th straight month of contraction. Now, this isn't just a small crash, everyone. This is an absolute massive crash. In April, the Chicago Purchasing Manager Index was 48, and anything below 50 is in contraction. So let's hit the charts to see how bad it's really getting, because if managers aren't purchasing goods, guess what? There's not going to be demand coming. So we can see on this chart here, it has been declining every single month since June in 2022. We can also see business confidence is in contraction at 47. Non-manufacturing PMI is pretty much flat at 51. But again, Chicago PMI 40.4. This is a huge miss. So this is a great forward-looking indicator so we can figure out what companies' earnings are going to be and what that's going to mean for the stock market. If companies' earnings continue to fall, that means when these companies put out these earnings reports, if they're not up to par, their stocks are going to crash like we've been seeing this past year. But there's so much more happening, everyone. Look at this. So obviously we have the debt drama that's been diffused for now. But what that's going to mean is there's going to be a lot more treasuries going into the market, and that's going to cause interest rates to go up, and it's going to cause these treasuries and bond prices to fall. But there's been some new big news for this retail saga we've been seeing, where retail sales and all these retailers are doing it very tough. They're closing a lot of stores, their earnings aren't up to par, and we got a new report from Macy's. So look at this mixed bag for retail, everyone. A slate of retail earnings reports have stocks swinging before the market opened Thursday, as some companies noted consumer weakness entering the spring season. Macy's shares dropped as much as 10% after the department store operator flashed its full-year earnings and sales guidance. This is why I say it's so important to look at these forward-looking indicators like the Chicago PMI index so we can see what's going to happen with these companies' earnings. We can see here Macy's stock crashed 10% on this earnings report, and you better believe we're going to see other companies hit just like them. The company said it saw weaker discretionary spending starting in March and has had to mark down seasonal merchandise. Now, some more very disturbing news came out for Amazon today, and it seems like Amazon has been spying on you if you've been using these Alexa devices. And this is why I've tried to warn people we can't digitalize everything, because these companies don't have your best interests and don't have your privacy at heart. Listen to what just happened. So Amazon agreed to hand over more than $30 million to the Federal Trade Commission to settle allegations of privacy violations, including its Alexa and Ring products, according to filings out Wednesday. Now, people, this is completely crazy. They've made hundreds of millions, if not billions, off this device, and 30 million is just a slap on the wrist and really just a speeding fine. The FTC claimed in a separate lawsuit that Amazon was improperly securing or holding onto video recordings and profile data of users, including children. This is absolutely sickening, everyone. In addition to the settlement, charges Amazon will be required to delete sources of data, and because according to FTC, Ring failed to implement basic measures to monitor and detect inappropriate access before February 2019. Ring has no idea how many instances of inappropriate access to customer sensitive video data actually occurred. This is absolutely crazy, everyone, and this is happening at a time when they want digital thermostats. So when they put these thermostats in your home, they can directly control how much you either heat or cool your home, so that way they can hit their climate goals. And this is why we can't let, these devices completely take over our home. Now, on top of this, people, something else we've been talking about, we're getting a lot more companies leave China in droves, and we're getting manufacturing being brought back onshore. Now, this is good for jobs, but it means it's going to lead to higher inflation, and it is more bad news for China. More and more companies are looking to bring manufacturing and operation home, pulling out the long-standing production powerhouse like China, in a trend called reshoring that could have massive implications for the global supply chain. According to Bank of America analysis, mentions of reshoring during S&P 500 earnings transcripts in the first quarter were up 128%. 8% over the same quarter last year. And this is even outpacing the growth in mentions of AI. There's a host of factors at play here: the Russian-Ukraine war, the effects of the COVID-19 pandemic, US and EU incentives for at-home production, and shifting demand due in part to the rise of TikTok. Still, remapping the global supply chain won't happen overnight, they say. So I think the real reason we all know why people are leaving China in droves is because of the geopolitical risk, because of the rise of the BRICS nations, because of the geopolitical tensions between the US and China. And look what China and the other BRICS nations and central banks are doing with gold. So look at this, everyone. Central banks are buying gold at a record pace so far in 2023. Now, just a very quick announcement I just want to say: I've launched a brand new course called The Golden Path to Wealth, Mastering the Trinity Portfolio. In this course, I'm going to go over how you can use gold, silver, and Bitcoin in a Trinity portfolio to hedge against the downside risk of recession, but also to hedge yourself in case there's another market melt up and these central banks don't bring inflation under control. I've made this course very affordable because I've seen so many YouTubers charging $400, $500, even $1,000 for their courses. So for just $149, I'm doing a pre-launch, a pre-sale where people get in now. Only 20 spots available today. You can get it for just $149. But as the course content comes out, as every module gets completed, the prices will be going up. So I'll put a link in the description to sign up to that course below. But again, back to what central banks are doing. So central banks have accumulated gold at the fastest pace on record in the first 2 months of 2023, according to a report by the World Gold Council. In January and February, central banks collectively brought a net 125 tons of the metal, the highest amount for year-to-date period since banks became net buyers in 2010. So we can see on this chart here, everyone, they are buying and buying big, and especially the BRICS nations. So the countries reporting the largest purchases in the first 2 months were Singapore, they brought 51 tons, Turkey 45 tons, China 39 tons, Russia 31 tons, and India 2.8 tons. And the Central Bank of Russia published an update on its gold reserves for the first time in about a year, and so the 31 tons were likely accumulated over the course of several months instead of January and February. So why do you think central banks are doing this, everyone? I think they know eventually fiat currency is going to die, and that's why it's so important for you to know how to master the cycles of gold, silver, and Bitcoin. Because unlike what most people do, try to go all gold, all silver, or all Bitcoin, you need to diversify and have them all work together. So saying here, BRICS countries will continue to be huge buyers. If you look back at the list of net buyers, you'll notice 3 members of the BRICS countries, which are Brazil, Russia, India, China, and South Africa. I point this out because as I've been sharing with you for a couple weeks now, we may be seeing the emergence of a multipolar world, with a US-centric world on one side and China-centric world on the other. For the first time ever, BRICS countries' share of global economy has surpassed that of G7 nations, Canada, France, Germany, Italy, Japan, the UK, and the US, on a purchasing party basis. So this is what I've been trying to warn about, everybody. BRICS is rising. They're rising rapidly. They're rising fast, and they're trying to rise up and take on the G7 nations. So to say here, and I completely agree, gold plays an important role in this multipolarization. The BRICS needs the precious metals to support their currencies and shift away from the US dollar, which has served as a global foreign currency for about a century. More and more global trade is now being conducted in the Chinese yuan, and there are reports that BRICS, which could eventually include other important emerging economies such as Saudi Arabia, Iran, and more, developing their own medium for payment. That's exactly right, everyone. I just covered this in my video yesterday, and we're seeing more and more countries are wanting to join BRICS. So also seeing big net inflows into gold-backed ETFs. So net inflows into gold-backed ETFs turned positive in March after 10 straight months of outflows as metal price flirts with a new record high. Investors added nearly 1 million ounces to all known physical gold ETFs in March, and the highest monthly increase since March 2022, when investors added 1.4 million ounces. And as of March 31st, total gold holdings stood at 93.2 million ounces, according to Bloomberg, and as we can see in this chart here. But again, there's a lot of uncertainty with what the Federal Reserve is going to do, and a lot of people are saying, why isn't the recession happening now? Well, again, people, this all happens with a lag, and the Federal Reserve has not hit peak interest rates yet. Over the past 70 years, a Fed pause was followed by an economic recession 75% of the time, with an average lag of 6 months. So that's right, that's from when interest rates hit their peak or when they pause. So they haven't peaked yet, And a lot of people are saying they may continue to hike interest rates in June, if not July, so we haven't felt major pain yet. The two analysts believe the Fed has just one more hike to go before it pauses and begins to reverse course. I think that will happen next year, people, not right now. So everyone, even though the markets haven't crashed yet, all the fundamentals are signaling there's going to be major pain coming ahead. Again, retail's earnings are falling. The Federal Reserve hasn't hit peak interest rates yet. Manufacturing is falling. Consumers are getting tapped out by record inflation. So I think we will get the news later this year that we're in an official recession. And if we do get that news we're in an official recession, we're going to see a big flight to safety like gold and silver. And also what's going to happen in 2024, there's going to be the next Bitcoin halving event. And I think that's going to be really bullish for Bitcoin as well. So everyone, if you're wanting to know how to master these 3 asset classes and get them to work together, you can click that link in the description, sign up to that brand new course again before the price goes up, before the course is completed. All the people that get in early, they'll get access to my email to request new lectures as well. And if I get a lot of people requesting the same lectures, then I'll go ahead and add that content. But for those of you that can't sign up or don't want to sign up, that's completely okay. Just for all of you that have been watching for the past 2 years, liking, subscribing, that's more than enough. So for my loyal viewers and subscribers that are watching, you're awesome. Thanks for watching. I'll see you all in the next video.